So we were able to scale on a revenue standpoint, again, $1 billion. And that was just from the US standpoint.
This is The Media Machine, where media, business, and innovation intersect. Hi, I'm Johanna Salazar, and I'll be your host as we examine the future of content, technology, and entertainment through the lens of 4 key pillars: process, profit, people, and planet. Today, we're turning our focus to one of our 4 key pillars: profit. The ways media companies generate revenue are shifting rapidly, from ad-supported streaming models and sports rights deals to new strategies for creators to scale their businesses. In this episode, our guests break down how profits are being made, where the biggest opportunities lie, and what the future of monetization really looks like. From Cathy Hackl's perspective on monetizing through emerging tech, to Sean Atkins' 5th quarter strategy for creators, to Evan Shapiro, Larry Jones, Alan Wolk, and Stuart Snyder on the realities of streaming, ads, sports, and scaling to billions in revenue. These conversations reveal the challenges and opportunities shaping the media economy today. What's your blueprint for media companies looking to monetize in the next wave where gaming, AI, and immersive tech are converging?
Well, so I don't think I have a blueprint per se that is like the same for everyone. I think every company has their own special needs or their own ideas and concepts that they want to implement. I do think there are certain things that I do across the board with all my clients, which is definitely try to understand where they currently are technologically wise and where they want to see themselves, right, in the next 5 to 10 years. Also looking at their consumers or the people that use their services or buy their products. Who are these people currently? Where are those people going to be in 5 years? Who could be new consumers? So that concept of next gen consumer or people that will need that service. I feel like at one point millennials were it, like everyone's like millennials, and now millennials are a thing of the past because we're older. So it's Gen Z, but now Gen Alpha, right? So it's, I think, looking at who are their current consumers, who are their future consumers, all these sorts of things. So as far as the blueprint, like I don't have like a all sides, like all sizes fits all kind of approach. I always come and learn about those companies, what makes them tick, where do they want to be currently and technologically, where are they in their tech stack? That's another thing. And I think a lot of people don't talk about that is like, what are they using currently? What are the systems they have? It can be a little complicated, especially if you're trying to implement like new commerce models, spatial commerce or commerce in the spatial internet, in gaming. There's a lot of things that need to change within an organization to make that happen. So understanding what are the restrictions that they have? What is the current tech stack? What are potentially new tools that they're going to have to use and implement? And, then you involve legal and procurement and a whole bunch of other things. So I'll have like a client say, oh, we want to sell things through the Vision Pro, right? That's a hypothetical, right? It's like, well, great, but let's look at how many people actually have the Vision Pro. Like, is that really going to be a profit driver for you? Or is this just more of a PR play? So things like that is truly analyzing what they're wanting to do. Does it make sense? And if so, in what context?
It's about the 5th quarter agency. What do you guys do? Why is this different? And how are you helping creators?
Part of what makes Dhar interesting is that, like, if you think about what's magical to a certain extent by creators is the audience feels a direct connection to a person, to a brand, to an experience. The flip side of that magic is that, you get beholden to the algorithm, which is sort of an is in the business. And then the second thing is, like, because you're a human being with a certain amount of capacity, you're the constraint, right? So if you think about it, if you wanted to sell your business and I was, say, like a Mark Rober, he is the business, right? And so the challenge for these creators becomes like, okay, well, how do I scale? How do I build a business that's bigger than me and it goes beyond me? And in Dhar's case, because he's just scripted, he was able to ease off the camera. So he's more like a Tyler Perry, right? He can be in the content. The audience loves him, but it doesn't have to be. Or a Walt Disney, right? Like I tell you, you can do it open, and then they don't expect you to be in the show. And so that allows him to sort of scale and build new things. But the other thing he looks about is like, how do you use your intellectual property? For you and I, we look at it as windowing in the traditional things. Like, oh, I made it. Where else can I sell it or use it to get leverage out of it? And so Dhar started prototyping how he took his content to multiple platforms, even the same platform, or like, can I make a compilation, or can I make a best of, or can I do a reversioning? Like all the things, again, we would do in cable a lot. He started doing this on his own. And it made what he refers to as like it's like I didn't have to do a lot of work and I made a fifth quarter of revenue. And so that sort of began what became fifth quarter ratings, because once he sort of had this additional cash flow from leveraging his library and understanding what works on what platforms, you can imagine he had other friends who were creators who were like, hey, what's that? And he's like, so out of that, he ended up servicing a bunch of creators. So we sort of helped them, that hence the title, find a fifth quarter of revenue by figuring out ways to leverage their library that doesn't require them to do more on camera work to generate revenue, to make their library value go up and to give them more sort of security in terms of producing, that they don't have to make as much content or as frequently as content, because the content they do make is leveraged for more reach. My contribution to the court is more just like helping him scale it from like getting more clients in the door, also helping him build other ways that we can do similar services for creators. And taking that sort of DNA and be like, okay, what other platform can we do it on? What other areas can we do it in? Like, so for example, when I came in the door, Dhar really is, if you sort of think about, stars of platforms, right? Like you could say, oh, the D'Amelios are kind of like the people who really built TikTok, right? You could say, oh, Beast was YouTube. Dhar really was the first face tuber, as he would say. Like I was the face tuber. And so, but that business, as his YouTube business exploded, he sort of started not paying as much attention. And so when I came in, we started paying back attention to Facebook. And so that business is actually just as big as YouTube business, which is pretty rare for a creator. It's usually a pretty big discrepancy. And he is sizable businesses on both. That's now a service we'll provide other creators, which we'll be making some announcement around soon.
What are your thoughts around new business models, and what does the next generation of bundling look like? What are your thoughts on that?
So we're talking about like streamers and
Yeah. I want to talk about money now.
I think that what's going to happen is, everybody's saying this, and I think it's going to it's already started a couple of years ago, but now I think it's going to really ramp up. But is consolidation. So many of these legacy companies, shareholders have become accustomed, to a certain kind of revenue growth and margins, and those are all being compressed. So a lot of investors are just moving out of those traditional companies, and so those traditional companies have to find a way to articulate a story that says they are going to grow, and I think it's extremely challenging. I think that the easiest way is to buy other companies and to consume their revenue streams and to enhance your own revenue stream. It's I do analogies on everything. It's like you buy one house or one rental property, and then you get some equity in that, and then you use that as your equity to buy another house, and then you buy another house, then you have another house, and you have revenue from all 10 houses, and it looks like you're making good money, but you're just covering enough to make your monthly payment because everything's been borrowed. And your friends say, "Oh my God, you're a real estate mogul because you have 10 houses." But the reality is, like, you're living on the edge. And I think that most of these companies are going to do the same thing. They're going to buy a bunch of real estate. They're going to enhance their revenue. People will look at them and say, "Oh wow, they're making a lot of revenue." They'll say like, "Oh, they have a lot of debt, but at least they have enough revenue to cover their debt, so I guess that's okay." And so I think that's what's going to happen in the near term. I would say that's going to happen pretty fast over the next year to year and a half. And then you hear all these rumors that are coming around, like some of the big boys, Apple. The great thing about Apple and or I should say Apple TV and Prime is that this entertainment thing that they're doing is like just a rounding error. It means nothing to their bottom line. It's so, Netflix, it's the only business they're in. Disney, is investing a lot in streaming, but they got parks, they got licensing, they're making most of their money off of that stuff. Prime, Amazon is making most of its money off of AWS and Amazon Web Services, and delivering brown boxes to our houses every day. So this entertainment thing is just a, you know, a literally is just a rounding error. So they have the ability to ride this out for a long time, stretch it out for a long time. They have the ability to pick up a bunch of libraries that might be laying around out there that, you know, some content that is going to be getting depressed more and more and more because people don't like these traditional media companies as much. The investors don't. So I say the answer is consolidation.
What do you think is going to happen with the ad tier on Netflix? And are they just setting themselves up for something bigger?
I think it's hard for them, right? So they sold themselves, especially in the US, in Europe, Australia, et cetera, as, hey, here's this great ad-free experience. Like that was one of the advantages, that you could watch all your favorite shows without ads. It's a big deal. And as a result, people got very used to that and associated Netflix with no ads. So now that they've sort of tried to bring an ad-supported version to the forefront, it's been very hard for them. And one of the ways that we always see how hard it is when they release their numbers, their global numbers, right? They're like, hey, we have, 49 million ad-supported subscribers worldwide, but worldwide includes places like Brazil and Mexico, where the assumption is there are a lot more people who are watching ad supported because the economics play, much more in play there than they are in, say, France or Germany or the US. The other thing that I think they're going to have to do is put a much bigger gap between the price for the ad-free and the ad-supported, because right now it's about a $10 difference. And if you think of the way a lot of new subscribers come in, is like, oh, there's a show on Netflix I want to watch. I think I'm going to subscribe for 3 or 4 months, and then I'm just going to get rid of it again. So what happens is they think to themselves, oh, so for $10 a month, I don't have to watch ads. That's an extra $40. No big deal. I'd much rather do that. But if it was suddenly an $80 difference or $100 difference, then they might think to themselves, well, maybe I will check out the ad-supported version. So I think it's going to be sort of a struggle for them. Now, they especially have to deal with the fact that Amazon did this nifty little trick about a year and change ago, where Amazon said, okay, Prime subscribers, you're all on the ad-supported version now. If you want to get off of it, there's a way you can find on the website. You can pay $3 more a month, and you can watch everything ad-free. But my understanding is, Amazon doesn't release the numbers, but by most estimates, only about 25 to 30% of their subscriber base took them up on it, which means they have the most ad-supported inventory in the US in particular, but even in Europe and in other places too, because so many people subscribe to Amazon. And Amazon's this weird beast where no one knows. I couldn't tell you, do I subscribe because I get free 2-day delivery, or do I subscribe because I like watching stuff on Prime? Sometimes it varies from month to month. The other thing with Amazon is they have a lot of sports programming, and sports always has ads in it. So a lot of people have said to themselves, okay, you know what? I'm mostly watching the NFL on Amazon. It's going to have ads anyway. Why would I pay them extra not to have ads? So I think you have that factored in. So I think it's not just Netflix, it's everybody else. It's, HBO, it's Peacock, it's Paramount, who are sort of struggling, but Netflix in particular, I think, gets hit hardest with that because people knew Netflix as, oh, no ads.
So the sports gold rush strategy or panic. Streaming platforms are funneling billions into sports, even as they cut budgets for scripted content. Are they making a strategic move or just chasing what's easy? Because we know Zaslav is not doing that.
He's not. And that's either good or bad, but he's also the problem with Zaslav's strategy is he's being cheap on sports, but he's also being cheap on everything else. So if he was diverting his resources from sports into scripted while everybody else was doing the opposite, that's a strategy, right? Mm-hmm. So what's happening now is the amount of sports contracts that we spend on a yearly basis has gone up around almost 300%. Mm. The current sports rights contracts for NCAA, NBA, NFL, WWE, and Formula One is worth more than the gross domestic product of Costa Rica. Mm. And so when John Landgraf came up with the phrase peak TV, he didn't mean it as a compliment. He meant it as a warning. I am guaranteeing you we are in the peak sports moment. And big tech can afford to do this, right? They can invest money in the NBA and NFL, Amazon. They can put money into Major League Soccer in a ridiculous form, Apple. They can put a shit ton of money in the NFL Sunday Ticket, YouTube, because they never have to show the bottom line of that one deal, right? So they're driving up the price for everybody else, and they're keeping their consumers inside their ecosystem longer, which is their entire strategy. But if you're a standalone programming entity at this time and you're diverting money away from entertainment programming into sports at the prices that big tech are mandating, yeah, I think that's peak sports. I think we're in a situation. And by the way, the viewership is not going up as a result of moving from traditional television to streaming. It's actually going down. The two Christmas games on Netflix did 20% worse than those same two Christmas games on CBS. And, Netflix will look at it as a win, but is it? They spent a lot of hundreds of millions of dollars, and now they're going to double down on that. They spent $5 billion on wrestling. Like, I get it. I understand why they're doing it. But at the same time, scripted programming in the United States, production is down 40% since pre-strike. 40%. So what's happening is we're making less entertainment and we're putting all of our money into sports, and NFL is on literally every platform. So we're becoming this monoculture where everybody looks exactly the same. Well, how are you going to sell that to consumers, and how are you going to sell that to advertisers? I don't think it's a strategy. I think it's a bubble.
I was just going to say, it sounds like it's a bubble.
It's a definition of a bubble, frankly.
How did you scale your businesses to over $1 billion in revenue?
There's a couple of things to think about in terms of that. First of all, we were fortunate in the day that we were operating, and it's a very different world today. I mean, I was living in an ecosystem of the cable industry. So the cable industry, back for my 10 years of Cartoon Network, Adult Swim, and my brands, our revenue stream was really cable subscribers. So we were living in a world of 100 million households having cable. That world doesn't exist anymore. So that 100 million is now down to about 50, 60 million households. So first of all, the economics have changed on that front. I was living in a thriving advertising world. If you've got successful shows and eyeballs, people watching your networks, our advertising revenue is up. So that's the second part of the tier of what I call the revenue stream. Next is having hit shows generating licensing and merchandising revenue. So on the scale of whether it's Adventure Time or Ben 10 or Steven Universe or regular show, even in Rick and Morty on the Adult Swim side, all of those had, whether you call it T-shirts, action figures, bed sheets, what I call licensing and merchandising. So we were able to scale on a revenue standpoint, again, $1 billion, and that was just from the U.S. standpoint. We were responsible. Again, we're creating content for as you said, globally. So we also had to make sure that our shows could travel across the country, and also we were across the world, and looking for shows that were working elsewhere that we could bring to the U.S. It's never easy sitting in that chair. It's a tough job, I will say that. But the thing about the content business is it's really an at-bat business. And what I mean by that is baseball terms. Baseball player is successful if they have 3 hits out of 10 because they're batting 300. That's phenomenal for a baseball player. In our business, in the television business, if we were batting 2 hits out of 10, that's great. So, because the 2 hits pay for the other 8 that may not have been as successful. So we just had to make sure we were putting out content and enough content to find that hit that really resonated on a global basis.
And that was then. Is it still the same, or do you?
Oh, it's even more pressure today. I look back on it and I'm fortunate that I was in that chair during that time.
That brings us to the close of our conversation on how media companies are redefining profits and revenue streams. Our guests reminded us business models are shifting, new platforms are emerging, and the path to profitability looks different for every creator, brand, and company. We hope these insights give you a clearer view of how the industry is adapting and maybe even spark ideas for your own ventures. Next week, we'll be dropping our compilation episode on the third of our 4 key pillars: people, the creators, executives, and changemakers redefining the landscape. Thanks for listening to our show. Be sure to rate, review, and subscribe wherever you listen to podcasts. You can follow us at The Media Machine Podcast on YouTube, Instagram, TikTok, Facebook, and X. The Media Machine is hosted by Johanna Salazar. Our producers are Mia Vinciguerra and Johanna Salazar. This episode was edited by Adriana Saravia. This episode features music from Envato Elements. Thanks for listening.